Let's get started, everyone. Thank you for attending. We are going to be fairly quick today. We're shooting for 30 minutes. That's including a Q&A. You'll notice at the bottom of the page, you can actually add any questions you guys have as we go through the presentation. Please go ahead and put them in the Q&A, and then we will answer those towards the end. I will be spending a few minutes just talking a little bit of an update on the market, what the market's done so far this year, a couple of events that have affected the market so far this year, and then I'll move more into the economy, what's driving the economy so far this year, earnings growth, and things like that. And then Eli Christensen, if you haven't met him, he's been with our firm for about almost a little over 2 years. He's a great advisor and a great friend. He'll be talking more about stock market metrics as well as portfolio positioning. By the way, question comes up all the time. Eli and I are not related. It's Christensen. I'm Christy Anson, and I'm not actually old enough to be his dad. So just so you know, you might think of it just looking at me, but not the case. So let's go ahead. I'm going to jump right in here. So this is Newton's first law of motion. An object in motion stays in motion unless acted upon. That's really all about inertia and momentum. And everyone, we are in a super strong market. So looking back over the 3 prior years, we're coming off of in 23 up about 30% for the market, 24 up about 30%. Last year for 2025 was up about 17%. And so far this year, we're up about 13 so far. Market's about 13%. Many of our portfolios have actually done a little bit better than that so far this year. The second thing I'll be hitting on as well is what could be act upon this market to cause it to change. I'll be talking a little bit about that. One of those things could be interest rates. If we had interest rates going up, that could actually put a halt to the momentum. Also, midterm elections coming up in the fall, November, that could cause an effect. But historically speaking, when we're in a strong market, over the short term, that trend continues to go on. If there's sectors that are doing well, stocks that are doing well in the near term, if they have a lot of momentum, then that generally continues on. You're probably familiar with the acronym FOMO, fear of missing out. In this market, there's a lot of people fearing missing out, but it's not because a lot of hype or other things. It's fear of missing out due to earnings. Earnings have been extremely strong this year, and I'll be hitting on that a little bit because that's really the driver of why we think things will continue to do well throughout the rest of the year. So if we look at, if we look at the overall market, the purple is the S&P 500. I'll be focusing on that, but also NASDAQ, a little bit more tech centric, is up about 14%, and the Dow's up about 13.5%. All of these are pretty much off record highs yesterday. The last 3 days have been super strong so far in the market. And again, really strong so far this year. No complaints there. But starting out the year, market was fairly flat. Going into March, up a little better than 1%. And then we had a war, or have a war, war in Iran, bombing, etc. That you can see the market started selling off end of February, and a lot of that was due to oil prices. Oil, if you would just read the headlines and think of what happened, oil jumped from $60 a barrel to $120 a barrel, up 50% in a month. That you would think the market would be cratering. It did sell off, but sold off roughly about 6%, and really over about 30 days. And then that really got evaporated in less than a month, and the market really shrugged it off, mainly because, again, earnings have been so strong, they've looked past it, and the economy has actually been quite resilient. So we'll look at oil, how that affects markets historically. If you look on this left-hand side, this is the war in Iran. You can see that's peaking at about $120 a barrel. Now we're about half of that. We're actually at 80, so a little higher than it was. But again, been really, really resilient. If you look on this right-hand side over the last 34 years, this is just looking at data across the board. Anytime we've seen an oil spike, generally we see a market sell-off for a couple weeks, but really fairly short term, 2 months after, market's up roughly 1.4%. A year later, up 12%, and 2 years later, up about 32%. So this one's already pulled the stock market's already regained really its losses and have extended that well past where it was prior. So a lot of this is already baked in. Again, markets just don't go up. We do think we will end the year on a strong foot going into year end. Historically speaking, best quarter of the year is going into holidays. A lot of spending's happening around the holidays, Halloween, Thanksgiving and Christmas, and also people just maxing out retirement plans, etc. But one thing that could cause a hiccup in that is midterm elections. That's happening in November. And again, I'm not talking politics here, just in general, investors tend to pull back a little bit and not invest all their money because of the uncertainty of the midterm. It's not necessarily who's going to win or who's going to lose. They just don't know what's going to happen, so they then tend to pull back a bit. So on this left-hand side, you can see this is all years going back to 1931, and you can see that fourth quarter generally that seasonally is a great quarter, the best quarter of the year. So you can see generally a tendency to go up. But you notice in this blue area, this is actually midterm year. The market's generally really subdued and doesn't do a whole lot until midterms are basically over, and then it spikes up. This year, we've already had a strong market, so we could have a little bit of a pullback around that. But really, once people know, regardless of who they wanted to win, if they even lose, they'll generally put their money back to work just because the uncertainty is over. They know who won or lost. They may make adjustments to their portfolio and then move on. Looking at midterm election years, this is looking at 1 year after the midterms are over. That 1 year return historically is about 15.4%, going from every other year, non-midterm year, that 12-month period going from November to November, only about 8%, 7.8%. So historically, the year coming out of a midterm usually pretty strong. So that's, we think, maybe a little bit of a tailwind going forward for the future. Okay, so let's get into the important stuff. Let's look at the economy, what's driving it, why is it doing so well or not doing well. Let's just looking at labor market. So you can see here, labor market has been pretty strong. The average new jobs created over the last 3 months, about 111,000 per month. So seasonally pretty good. There's been a lot of worry about potentially AI stealing jobs, and I think that certainly could happen in the future. But so far, from the CEOs we listen to, they are basically using well qualified, smart employees and then adding on AI along with them and just allowing them to be much more productive. So we really haven't seen that yet. Looking at the unemployment rate, so historically, the last 30 years has averaged about 5.5%, and we're at 4.2%. So we peaked up a little bit over the last couple of years since 2023. Unemployment rates actually dropped down a little bit this year. So still under average, we're still well below the average. And in our mind, we're pretty much at full employment for the US economy right now. Okay, consumer balance sheets, looking just as a whole, how are we doing as Americans? Left-hand side here, us as Americans collectively, we own about 204.5 trillion in assets. The last event we did 6 months ago, this was at 202 trillion. So we've accumulated about $2.5 trillion in the last 6 months, and a lot of that is due to the strong stock market, which is down here. Historically speaking, homes used to be the biggest asset that Americans owned, but by far, over the last decade, it has been financial assets, pension funds, cash deposits as well. Cash deposits are at record highs right now as well. The amount of debt, looking over here at the liabilities, biggest debt that U.S. households have is their home. 67% of it is in a mortgage. Again, that's good debt, but really not too bad. This is just looking at car loans, only 7%. These two right here is basically credit card debt, revolving debt, about 6%. for credit cards, not horrible, but we're keeping a close eye on it. So if you look at this, roughly debt is about 10% of assets. As a whole, we're all doing really, really well. We all wish that our faithful leaders in the government kept the balance sheet of the government and our country similar to the way we do. We'd be way better off. Looking here on the right-hand side, household debt service ratio. This is kind of like golf. The lower the number, the better. This is looking at all the obligations that you have as a homeowner, or actually for a household. Only 11.1% of income coming in is going towards paying debt or mortgages. So pretty good. Big reason for that is back during, you see this how it bottomed out right after COVID. That is because interest rates dropped down into the 2% and 3%. Majority of us, if we have mortgages, refinanced, and that gives us a lot of flexibility, and that's why this is so low. Also, housing prices have gone through the roof the last 4 years. So most of us that own homes have a lot of equity in those homes. So if we were to have an issue, you could always tap that for some equity to get through a hard spot. That's something that gives households a little bit more flexibility. Bottom right, early delinquencies, we keep an eye on this. This can give us ideas of trouble coming in the future. Credit student loans, you see that spike up. That was when loan forgiveness went away. A lot of people thought that student loans would be forgiven. That didn't happen. So you saw a lot of defaults with that. But really, 3.8% of mortgages they're 30 days late. Not bad. That's pretty much flattened out. Also, credit card debt and car loans have pretty much flattened out too. And below this massive peak we had back in the real estate bubble in 0809. So as a whole, consumer finances are pretty strong. Okay, this is probably the most important slide I'll show you today. I'll walk you through it. This is just looking at earnings growth and profit margins. So key thing I want you to remember, the stock market historically follows earnings. This is where we are for 2026. We started off the year at about actually about 14%, and then in June it bumped up to 23% earnings growth estimate for the whole year, and this was just updated in July, 30%. So 30% earnings growth for this year is absolutely amazing, and we are just seeing profit margins and earnings at a really, really strong point. And that is why, excuse me, the market is performing so well and doing well. The forecast for next year and 2028, 13% and 14%. This right-hand side, looking at profit margins, you can see here, going back to 2002, this little dip right here, that is the real estate bubble. And this little blip right here is COVID. But you follow this trend line up here, profit margins have continually gone up over time. And right now they are at record highs. We've never seen earnings or profit margins as high as they are today. So again, very, very strong. And we think no sign of recession anytime soon. Okay, this is just looking at overall. It's not just us that's doing well, but also the whole globe is. This is before it just barely was updated in July. It was 23% in June for US. So last year we were 13%. This year will be over double that at 30. Europe slightly better, Japan a little bit better. Emerging markets, as we're seeing massive, massive uptake there and massive growth. A lot of that is around the AI boom. Taiwan Semiconductor, they're the biggest foundry that makes basically every microchip on the planet. Their profit margins are sky high, and they're doing really, really well. And then also in Korea, South Korea, we have SK Hynix, and also in Samsung in Japan that are making fast computing flash memory. which is a big need for AI. A little bit of increase in China. So why this is important is if if it isn't just us doing well, but it's all global major economies doing well, if they are doing well, consumers are more willing to buy our products, more willing to come to the US and travel and things like that. So that again, spending begets more spending, and people feel better about spending when their stock markets are doing well. Okay, this is a major reason why a earnings per share has been so strong, and also the reason why the market's done so well so far this year. It's looking at the amount of spending that's happening around artificial intelligence. So these companies are called hyperscalers. That just means they're spending the ones that are spending the majority of the money for artificial intelligence infrastructure, microchips, data centers, technology around energy, etc. So Google, Amazon, Facebook, Microsoft, and Oracle. You'll probably see we'll probably see SpaceX and XAI pop into here. They already went public, so that I think they'll be in here next quarter. But this is the number for this year, 791 billion. Beginning of the year, this was forecasted at 520 billion. It's already increased up to about 800 billion, and over $1 trillion will be spent next year and the year after that. If you think about that, roughly $800 billion of additional spending happening, that is getting splashed around all over the economy. And that's why we're seeing economic numbers do well and earnings so strong. Think of this as basically like a massive stimulus package, not coming from the market, but coming from public companies that are being spent. The amount of employees that electricians, et cetera, that are actually being employed right now is absolutely insane, mainly around data centers. And I know there's been a lot of news around data centers, whether we're going to get one here, not get one here, etc. I'll just say if they're not happening here, they're happening somewhere because that is basically the only limiting factor to compute is basically actually the no excuse me the only limiting factor to artificial intelligence is compute, and there's data centers going up all over the place. So we see this as a massive tailwind regarding the economy over the next few years. Again, this amount of spend is going to be a tailwind of just additional money in the system that people are going to be out spending and other things. Biggest question we get, are we in a bubble? Okay, so this left-hand side, I'll focus here for a minute. This is the tech bubble, internet bubble back in the late 90s, 98 through 2001. You can see the blue line is actual earnings. The green line is the stock market. Earnings were low because internet companies back then, pets.com, Netscape, they really didn't have any earnings, but the hype around it, their stock prices went sky high with really no earnings to back it up. That right there is a bubble. This time you can see earnings in blue again, but also stock market prices. Like I mentioned in that first chart, stock market's just following earnings. So definitely not a bubble right now. I'll just give you one example. A company like NVIDIA, they are the main microchip company that is driving artificial intelligence technology. And if you look at their stock 4 years ago, over that time, it's up like 900%, but their stock has actually gotten cheaper because their earnings have gone up so much. So he was trading 4 years ago about 80 times earnings. So that's just looking at the price of the stock divided by earnings. That's about 4 times more expensive than the stock market. Today, they're earning almost $100 billion every 3 months. And with that massive earnings, their PE ratio, that same ratio, is about 20, which is actually cheaper than their overall market. So again, massive earnings. And with that, that's actually deflating the bubble because it's all backed by those earnings. So just real quick recap, I'll turn the time over to Eli. Just these are the assumptions for the rest of the year. Again, no recession, economic stimulus from infrastructure and AI build out will continue to fuel the economy. And also one thing in regards to the new tax bill, there's a one point in there, it's called accelerated depreciation. If you're a business owner or a construction company, you can go out and buy a building, buy Caterpillar earth movers, which Caterpillar's up 130% so far in the last 12 months because the demand to move dirt around data center and also electricity innovation is so big, they can go out and do that and actually expense that tractor or a building or truck or whatever all in 1 year. And that's really driving a lot of spending in the economy. Again, strong corporate earnings, estimated at 30% for the year. And then the global economic boom should be able to increase output, not only for the US, but other countries as well. Okay, that's all I have until Q&A. I'm going to turn the time over to Eli, and he'll pick up and talk a little bit about stock market metrics and basically portfolio positioning for portfolios.
Awesome. Thanks, Parker. And then also, if you could navigate for me. I don't seem to have the functionality. And sorry for the video. I don't have any video controls either.
I noticed that.
Maybe that's a good thing. So yeah, I'm going to go in a little bit more into depth into Parker and I's thought process when we're actually making investments in your portfolios, when we're really taking action, and where we're thinking of taking action. I'm also going to pull up some slides that we looked at the beginning of the year, and where we made some adjustments and changes, and see basically how those have gone year to date, and how that's playing into our thinking and thought process for the remainder of the year, and then also heading into 2027. So really, when we're looking at where the growth is going to be coming from, we look at it in these three main expansionary areas of the economy. Because AI isn't just a technological phenomenon, this is permeating through basically all industries everywhere. And it's going to affect them in different ways. So as you see on the left-hand side, this is where we've seen the majority of the returns over the last several years. Those companies that are involved in actually building out the AI models, the infrastructure of it all, the semiconductors, and the application layer, and that's still maturing in and of itself. But this is where we've seen the majority of that growth. And we saw that all the way through last year. And then heading into this year, we talked a little bit about this, where we saw that there was probably going to be a rotation from the AI tech stack more towards the secondary beneficiaries. And that's because a lot of the AI tech stack companies, they are at capacity as far as demand goes. So there's more demand than there is supply. And for many of those companies, they basically have their revenues projected out for the next couple of years. So it's matured in that sense, even though it's still going on. So where we're seeing that next phase of growth is in these secondary beneficiaries, and we started adding to some of these areas at the beginning of this year because we could see that broadening out happen. And then heading into 2027, we're going to start taking a closer look at those third-tier beneficiaries. So we can go to the next slide. So this kind of shows the growth and that overall expansion. So on the left-hand side, you'll see the improvements that are being made in AI. So this is measuring where basically the efficiency and effectiveness of AI being able to complete tasks at an 80% success rate. As you can see in this graph, the updates and improvements were basically happening about once every year up until 2024. Then it started happening basically quarterly. 2025 starts happening monthly, and here we are in 2026. Updates and improvements are happening basically every 10 days or so, soon to be weekly. And it's projected by the end of this year, heading into 2027, that will actually end up being nearly daily. And that's why we're seeing massive amounts of spend from these companies, is because they've got to catch up to the technology. The technology is growing faster than the compute and the availability to run those computations, which is why we're seeing massive expansion very quickly into those data centers. The other reason is the acceleration of usage. So on the left-hand side, or on the right-hand side, you see companies' adoption rates. We showed this graph at the beginning of the year, and I believe it was around 12%. We're now at 22%, and it will grow obviously even more from there. So the adoption rate's doubling. The other thing that's happening is the effectiveness of usage. I could tell from personal experience, using AI, at the very first, I would just use it to basically ask questions that I would normally just type into Google. Whereas now you're able to ask it more in-depth questions and ask it to complete, substantially more tasks and have it interact with other applications, allowing, for myself, who's not the most tech savvy person, to be able to complete technological and applicational feats that it would normally take people years to learn. So not only is the adoption rate increasing, but the effectiveness of usage is increasing. And that's why we're seeing that happen within the industries, and other companies are now becoming more and more profitable. And we're seeing, like Parker had pointed out, a 30% earnings growth rate for this year. So it's happening quickly. And then we can also see it in the returns. So if you go to the next slide, if you look on the top left-hand corner, the S&P 500, if you take out the Mag 7 and compare it to the other 493 stocks in the S&P, obviously massively outsized returns every year until we get to 2026. The other 493 companies have grown at 12%, whereas the Mag 7 has grown at 5%. And so we're seeing that broadening out, and it's because these other companies are becoming more effective and more efficient as they leverage and use AI. And as the Mag 7, those companies get mature in their earnings growth. And so we are still seeing, massive increases in earnings growth for those Mag 7, but a lot of that is, like we talked about earlier, somewhat predictable because of the demand is so large and they are at capacity. But if you look at that blue bar in the bottom left hand, you'll see the other 493, and you see their year-over-year earnings growth having double-digit, is growing by double digits each year. And we see a lot of this trend continuing on for the remainder of this year and 2027. If you go to the next slide. So this is a chart that Parker showed earlier, but it kind of helps illustrate that these companies that are the Mag 7, as they have these massive earnings, they are turning it right back around and reinvesting it back into the economy and those other companies. And so for us, heading into this year, when we looked at this chart, we were thinking, okay, where are they going to be spending these dollars? And where are we going to get basically the most bang for our buck in terms of investment? And this is not going to slow down over the next several years. As Parker had shown, the capital expenditures are going to be in the trillions of dollars going forward. And we just don't see that slow down. And to show that this can be sustainable, this kind of pairs well with another chart that Parker had shown. So if you go to the next slide, how long can this last? So this kind of shows in a different setup. It's your typical bull market lasting 70 months. We're at about month 40. And if you see some of these larger runs that we've had, they can last upwards of 100 plus months. And so we are probably only about halfway through this bull run at minimum. Go to the next slide. So I wanted to touch base with this is a chart that we had shown at the beginning of the year, just to highlight a couple of investments that we had rotated into going into 2026 that kind of fell into our thesis about the broadening out. So SCHV, we had talked about, we're going to lean a little bit more into value because we are looking for those companies that have good earnings and cash flow to be able to capitalize on the investments needed to expand their AI usage. And then also overall broadening of the market, people realizing that other companies are going to be benefiting from AI. So year to date, this investment is up nearly 19% as of end of day yesterday. And then AIRR, this was to highlight an industrial play that we saw happening. So the picks and shovels, the people laying the concrete, laying the pipes, building those data centers. This is an investment that we use to help get us plugged in there. That's up about just shy of 25% year to date. And then also going in and leaning on that strategic growth, we also saw that there was a big disparity in small and mid-cap companies and that they hadn't participated. And we do see these companies being major beneficiaries in the long run with AI because really it's becoming cheaper and cheaper to use and giving smaller companies the ability to do even greater things. That is up a little over 17.5% year to date. And that's really helped our portfolios. So the next thing to look at is how have these portfolios done year to date. So I've highlighted here three of our main portfolios. I'd say these are the ones that are leveraged the most and we use the most with our clients. So our aggressive growth portfolio, for those of you in that accumulation phase, the purple line is our portfolio. The gold line illustrates its relative benchmark, so the S&P Risk Aggressive Index. So in comparison, our portfolio is up a little over 18.5% as of end of day yesterday, whereas the relative benchmark is up just shy of 12%. So that's more than a 50% alpha that we're getting, taking on the same kind of risk, but getting a much larger return. And then for those where we are managing individual stock portfolios, so our focused equity, where we're a little bit more rotational, we will look to rebalance this a little bit more often. We're a lot more strategic with it. This portfolio is up just shy of 20%. Whereas its relative index is up just shy of 14. So again, a large, about a 40% alpha that we're getting in that portfolio. And then in our more conservative portfolios, for those that are retired, we leverage this portfolio quite often. It is up 11.25% compared to a similar benchmark portfolio 60/40 at 8.3%. So going into, and go to the next slide. So we've seen that same rotation. We kind of had some of these predictions and ideas ahead of time, and we want to keep staying ahead of the curve. And that's why I refer back to this slide again. We are looking at, there's still areas of opportunity within the secondary beneficiaries. There's still some opportunity there. There's still things being flushed out. And we're taking a hard look, especially in the energy sectors and in specific materials. And then heading into 2027, we see that there's going to be a lot of great opportunity for those that are starting to position themselves into the third tier. So financials is one that we're taking a good hard look at. There's a lot of opportunity there for them to become incredibly more efficient, which will really help their margins even more so. And then also media and entertainment is one that's being effective already. And it's able to drive down a lot of costs in that industry. So we're looking at those who are we're leveraging that. And then I'd say the biggest area of growth, and right now it's hard to predict on who's going to be the biggest winners, but the biggest area of growth that we see in this next year is also healthcare. Efficiencies are needed in there, as we all know, if anyone's ever been to the doctor. There's a lot of opportunity for us to expand in those areas. So that's what we're looking at heading into 2027. I would say, anticipate still a little bit of choppiness, people trying to figure out who are all going to be, in the end, the winners and losers, much like when the internet came on board. Not every internet company was a winner, but those that knew how to leverage it effectively, and make it a good use for the overall consumer and economy. Um, yeah.
Well said. Well, that ends our presentation. We'll see if we have any questions, Eli. Let's see. Well, I guess we explained everything so well. We didn't have any questions, Eli. I'll just maybe throw out one I thought of, just in case nobody wanted to ask one. And this is just common because we're just again off record highs. This is just looking historically. Um, the best time to invest. Obviously, buying in at market bottoms, you can get massive returns upward. But oftentimes, generally, the fact of the matter that you're not staying invested and you're sitting in cash, not earning a whole lot, trying to time it tends to be a fool's errand. No one can effectively time the market. So you can see here, this is actually all-time record highs, and you can see over time here on the right-hand side, investing any day, um, and looking forward, you've got about a 75% chance of making money over a 5-year period of time. Whereas if you invest at a new high, about 81% return. So even though our record highs, generally speaking, what I mentioned starting out, momentum generally begets more momentum, and that's what we're seeing is a lot of inertia in the market. So generally speaking, looking at over the long haul, you might not think of it this way. Generally, it was interesting to me to see this as well. But buying in at a new high, generally better than any other day. I just thought that was interesting. So thank you all. I'm just going to check real quick and see if any questions popped up. Thank you all for attending. No questions. So we hope you enjoy the rest of your day. There will be a replay of this. If you missed something, there will be a replay available in the next couple of days. Thanks for your time. And again, thanks for your trust in us, allowing us to do what we love every single day. And we hope you have a great rest of the week.